Hello everybody, welcome to our special webinar on our V32 trading strategy. We're going to be talking today about high trade returns in a bullish environment, which we certainly have been in for the last couple of months, haven't we? So before we get going, let me just quickly remind you that this presentation is for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial, and please make sure you are aware of all your risks before and prior to placing any trades. Also note that in the presentation today, we're going to be discussing hypothetical computer-simulated trades and performance. They're believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many different reasons. So we have Stephen on with us today. Hey, Stephen.
Hi, John.
So Stephen's going to discuss this with us. If anybody has any questions, you can post them into the chat. We'll do our best to answer them in the time that we have and as they're relevant to the topic that we're speaking about. So what is V32? Well, V32 is a high probability trading strategy, or some people call them an income strategy, and it's a shorter term high probability broken wing butterfly income strategy for the Russell 2000. Now, the V32 was strategically designed to perform best in uptrending markets while maintaining a great overall win rate over time. And you'll see that as we start to go over performance results and so forth. Now, this strategy is something that we put into our stage 3 of our trading success blueprint. And our stage 3 trades tend to be very rule defined so that beginners can follow them. And they tend to be also relatively simple to trade. So that's why it's in that category. However, within the V32 strategy, we also have lessons on subjectivity for those who want the highest returns and the most consistent returns, especially when you start becoming more and more advanced in your trading. One of the things, or one of the reasons we came out with the V32 is we have this popular trading strategy called the M3. And that too has a very high win rate, but we had some clients that had some requests on making things a little more simple. The M3 itself is a $50,000 trade, and it can be traded with as little as $5,000, but it's a lot of work. The V32, on the other hand, we corrected all that. With the V32, we can trade easily with small accounts. It can be traded with as little as $3,500. There's no trade overlap, which is another concern some people have. They don't want to be in 2 or 3 or 4 trades at the same time. They'd rather just prefer just one strategy. The position has fewer adjustments than most income strategies that are available out there. It has a more defined rule structure. We get better performance in uptrending markets, which we should know historically. We get uptrending markets more often than we get downtrending markets. This also provides better performance in those pesky down-up whipsaws. And we've had so many of those over the last, multiple years here, where you're in a market neutral trade, you adjust the trade down, and next thing you know, the market flies in the other direction and you lose it to the upside. This generally, or almost never, will lose in that situation, assuming, of course, the down move itself wasn't overly powerful for it. And another big advantage here with this strategy is that it has minimal sensitivity to different analytical software. So we're going to look at this trade in a couple of ways. We're going to look at it non-subjectively traded, and there's really 2 different ways that we can trade it non-subjectively. And we're going to take a look at it a little bit subjectively traded, and then I guess maybe 3 different ways, because we're also going to take a look at it in the context of maybe combining it with some other income strategies like the M3 or bearish butterfly or rock trade. So as far as performance goes, our long-term performance on the V32, and I'm talking 2008 to August 2020, has been substantially higher than most income strategies, and that's even most of our own income strategies. Our highest performing strategy over that period, over the whole period, is going to be the rock trading strategy. Our second highest performing over that whole period is going to be the V32. The performance of this strategy is going to be similar, whether you trade it in option view, in O&E, or you just simply monitor it with Thinkorswim. Now, you will get differences because each of these platforms will show you different delta numbers and so forth, and therefore that's going to create sometimes different entries and exits and adjustment points, but it's not overly sensitive to those differences like some other strategies are. So realistically, we can monitor them in anything. As a matter of fact, when this was tested, it was tested from 2008 till 2011 in option view, and then the remainder of it was tested in O&E, simply because O&E, you don't get intraday data before 2011, so that's as far back as you can test. And really, we saw similar results through the whole process. And then since 2017, I've also been monitoring this side by side with Thinkorswim, which again, you're going to get some different numbers thrown at you, but the performance is similar. We can trade this with as little as $3,500, and also it tends to require fewer adjustments than many of the income strategies you're going to see out there. Not fewer than all of them, but fewer than a lot of them. So this is what we get for the non-subjective version of V32 with our back-tested performance. Now, we did have a stall in late 2017, early 2018, early 2019, but you can see we're right back up on the horse again and moving again. Now, one of the things that you hear people talk about when they're looking for a non-subjective trading strategy is they want to see a completely flat uptrending equity curve. And a lot of them can create that through back testing and form-fitting rules. And a lot of them times they only go back to like 2011, for example. But this was similar. We had a similar drop in 2008 with this, and then 2009 all the way until late 2017. Unbelievably good run, and then 2018, like I said, early 2019, a little rocky, and now we're climbing back up again. So you will experience this with any rule-based trading strategy. One of the biggest mistakes that a lot of people make when they're trading is when their rule-based trading strategy, if it's truly a high probability strategy, they win 70, 80% of the time. A lot of the times, a lot of the better strategies, they will run through these fluctuations. And a mistake that a lot of people make is when they run through those fluctuations and run away from the trade, right? When the trading strategy starts to drop off a little bit for a period of time. But really, that's the worst time to run away from the trade. That's just the strategy experiencing its 20 or 30% of the time when you're going to take losses or have a hard time. And the reality is, most of the time, that strategy is going to perform best after one of those moves. And we saw that in 2008. We saw the strategy drop off in performance during the 2008 crash and the following volatility in early 2009. And then we see 2009 is strongly positive, 2010, 11, 12, 13, 14, 15, 16, 17. And then we have this little drop off here from the volatility we had recently, and now we're back on the horse again, so to speak. So this is going to happen, and the challenge you're going to have if you're always chasing what's been doing well recently is a lot of times what's been doing well recently isn't necessarily going to do well in the next couple of months. And you get into this thing of rotating from strategy to strategy to strategy, which is not going to be very beneficial because you're always hitting it at the wrong time. So the fact that is here is not a concern, is what I'm telling you. And I actually see it as a good thing because now you're not coming into this blind, right? So anyway, historically, and this is from 2011 to today, including the bit of a down period. And if we look at 2008 to 2011, we get a similar result. This wins 80% of the time, and its average win is close to its average loss. So this is a very important factor when it comes to trading, especially when you bring it into how often the trade wins. So ultimately, I like a trading strategy where the average loss is not that much higher than the average win. In our type of trading strategies, our average loss will generally be a little bit more than our average win. You see that here. It's about 20, 25% more. And that would be normal. What I really, really like, though, is that our largest win versus our largest loss in the whole period. So this is where a lot of these so-called super high probability income trades start to have challenges, is you'll see their largest win will be $1,000 and their largest loss will be $7,000 or $10,000 when you run a test like this. And that's not the case here, right? So our largest wins easily exceed our largest losses. So I really like that in a strategy when I do it. As far as maximum consecutive wins, we have 19, maximum consecutive losses are 4. That actually happened in this period here.
I just want to make a comment on that, John, before you go on. Yeah, I think that's a point we want to drive home, is because this speaks to, at the end of the day, the only math that matters is expectancy, right?
Mhm.
So positive expectancy, meaning we take the probability of a win times our average winning trade, the probability of a loss times our average losing trade. And a lot of these systems will have 90% win rates, and that's where they want everybody's eyes drawn to that. But to John's point, if your average loss is 2-3 times your average winner, your win rate gets overwhelmed. In other words, that's not a dominant metric. So at the end of the day, we want to really look at what is the expectancy of the trade, and that's largely driven by the average win versus the average loss. Because as you know, John, a lot of the faster traders, lower time frame traders have 50-55% win rates and
Mhm.
make 7 figures a year. So
Exactly.
different field, but the math is the same. You know, different playing field is what I mean, but the math is the same. So you say, golly, 55% win rate, that's horrendous. Well, their wins are 3, 4, 5 times their losses. So I think that's real critical, and that a lot of times in some of our trading, we may end up with, you know, I call it iron condor trading, right? Little bitty win, little
Mhm.
bitty win, little bitty win, massive loss, little bitty win, little bitty win, little bitty win, and you're just on this hamster wheel. And if you just look at the expectancy of the trade, which is also expressed as a profit factor, by the way, it's just a ratio instead of the other formula, it would tell you that. And so this trade, it really stands out from that standpoint. It's you know, almost 1-to-1, the average loss and the average win. And then of course you factor in the extremely attractive win rate, and you've got the math formula for a winning trade over time.
Absolutely, absolutely. And so we have a question here. What's the planned capital for those back testing results? So yeah, this does show in dollars actually. So $35,000 planned capital is what I do my back testing with. When we talk about our non-subjective V32 performance, we have an 80% win rate. Just to review, the average annual return on that is 38.7%, which is extremely impressive. Again, higher than a lot of income strategies that you'll see out there. With this, and this is done without overlapping trades, so we don't have that trade overlap. And this is also done checking the position once per day. So basically, we have 3 different ways that you can trade this strategy, and we address all 3 of them within the program. One is a variable entry based on a combination of entry pricing and exit, and the exit of the previous position. And when we did our testing on this strategy, we did that in that manner from 2008 till mid-2018. In mid-2018, we started covering this strategy on the Options Trading for Income webinar that we do on Monday mornings for our Go members. And for simplicity's sake, we're using the 30-day to expiration entry, which is very defined, right? You just enter it 30 days to expiration. And then, of course, you could trade it subjectively. And we don't show results for subjective trading because they're subjective and it's hard to backtest that way. And anytime you do stuff subjectively, you have to question the backtesting results because they can be altered really, really easily. But we do have traders trading this subjectively, including myself, and you can really escalate your returns in that manner. So those are the 3 ways that we talk about trading this strategy. And some basic trade information here is we trade on the Russell 2000. The analytical software we use, where I'm using Option Explorer on our Options Trading for Income, but realistically you can run Option View and EIOIO. It's fairly similar. And you can run it in Thinkorswim. Again, fairly similar. We have the general entry configurations, a broken wing butterfly, 60-40 point wing. Our example sizes are going to be $35,000, but realistically it's simple enough where you can just trade it with a size of $3,500. To trade it exactly as we show in our examples, you'd have to use a 2-lot, which is a $7,000 planned capital. But if you go in and use 5-point strikes, $35,000 is easy enough. So basic trade description and back testing parameters. Our trade duration is going to be generally up to 30 days. In other words, we may end up exiting early, but it could be longer or shorter actually when we're using our variable entry date option. And I'm going to show an example of each of those. This strategy is checked once per day at 3:30 Eastern Time. The only exceptions being if we have to adjust our time due to obvious mispricing or holidays. So in other words, when we backtest, and I don't know how many people check this, based on people I talk to, not many, but a lot of times if you're just checking it once a day, or even on the defined time frames that you have in your backtesting software, sometimes you can get areas of time where something's drastically mispriced. And I will correct for that. So, as we're doing our back testing, we'll look at this number, a certain number, whether it be a delta number or whatever, and we'll say, oh, wait a minute, this doesn't really look realistic. We'll check it 5 minutes before, 5 minutes after, or we'll check the scatter plots on the charts just to make sure that that's an accurate number. If we have obvious mispricing, we will alter that time frame. This strategy does not have a profit target. Our expected profit per winning trade, when the trade wins, is generally going to be, on average, it's about 5%. It does win sometimes as high as 25, 30% on certain monthly cycles. And our exit loss trigger is going to be $250 per lot, which is going to equate out to about 77.1% of planned capital. Okay, so I'm just going to show you graphically what this strategy looks like, and I'm going to go over an example of a non-subjective 30-day entry, and then we'll just talk about a variable date entry and why that's there. Mainly it's based on IV skew and previous exit, but we'll talk to that when we get there. And then I guess, Stephen, you can address some subjective or technical entry exits stuff. Yep. When we're subjective, some of the things that we can do is we can enter on bullish chart signals. We can exit on bearish chart signals, right? So rather than going, I'm going to enter 30 days to expiration, we can say, oh, we have a bullish chart signal today. I'm going to enter it. And then when we get to a point where a certain rally or a cycle is exhausted, we can exit that way. Again, if you're a subjective trader, we can use our techniques in Ultimate Income Trader, where we talk about price pattern targets and market cycles and all this other stuff to plan our trades out with a V32. To become even more effective as far as returns and consistency goes. Or we can combine this, the V32, and we can do it very effectively with either the M3, the bearish butterfly, or the rock strategies. So let's just first look at actually, we'll look at this one first since it's up. This here is a variable entry date. Like I said, we can enter it 30 days to expiration, and we can do that consistently. So even on our variable entry date, we try to enter it 30 days to expiration. But sometimes what happens when you get very close to expiration, you get into a 60-40 broken wing butterfly, you're going to be very negative delta. In other words, sometimes you put a 60-40 on and it's positive delta. Sometimes you put a 60-40 broken wing butterfly on 30 days to expiration and it's negative delta. Sometimes it's drastically negative delta. And basically, the cost of the butterfly or the delta of the butterfly when you enter in that position is going to be very heavily dependent on what the vertical skew is on the implied volatility. And in 2013, we had a very different environment than we did today. You got to remember, when you're testing a trading strategy today or in the last 2 years, it's an extremely different implied volatility environment, not just from a raw VIX number or a raw implied volatility number, but from the standpoint of our vertical skew and our implied volatility skew curve. So you're going to get very different looking entries and very different looking costs as you go along. Now, when we get a what I call a smiley implied volatility skew curve, you get into a situation where when you put on a 60-40 broken wing butterfly, you're very, very negative delta. So to fix that, what we do is we roll in the upper long strike to get ourselves to positive delta. And in some environments, we have to drastically roll in this upper long strike to get that to positive delta. So in those cases, one of the options or entry options that we have with this strategy is we can go further out from expiration, because we can go further out to expiration, you can get a more favorable implied volatility skew curve. And you just go as far out as you need to in order to get the desired result. So in this case here, when we do a normal entry, we're going to go basically 17 to 27 points under the market with our short strikes. This one puts here from 942, we go 22 points under. That's within the range. We put our short strikes on. We go 60 points. We put our long strikes on. We go 40 points. and put these long strikes on, and we check and see if we're negative delta or not. If we're negative delta, we're going to roll these, start rolling this in to get to our positive delta number. We're going to check our capital. We're going to make sure that our capital is not over $35,000. If our capital is over $35,000, we'll move this in. And then we'll readjust our upper long strikes again to get that. Now, on a 30-day entry, we might be doing that in low implied volatility, or we can come out, again, we can go out in time, in this case, 53 days. Now, the reason we're going to enter at 53 days is a combination of two things. One is when we exited our previous trade, and in this case here, our previous trade was also exited at a different or a variable time frame. So we came in here and did this, and when we're in variable time frame mode in very low implied volatility, we're generally going to keep the position further away from expiration because they get more dangerous in that environment. So, we might be trading from 53 days to 33 days to expiration, for example, or 53 days to 18 days to expiration rather than that. So this is an example, again, of that varying time frame. And when we went to enter, here we have parameters on how short we can make this upper wing on entry. And this is within parameters. So now I have 5 40-point wings, I have 5 30-point wings. And this is going to be our entry position. So you can see here our total capital in the position is just a little over 25,000. We're positive delta. And this is basically how we enter the trade. And from here, it's pretty simple. If the price comes down under our short strikes, we're going to roll this back. If the price goes up or starts to become negative delta, then we're going to roll in the upper long strikes. At the same time, we're also being aware of how much capital we have in the trade, and we'll reduce the capital as needed to stay within our capital limits. And that's basically it, other than the rollback point will change depending on how long our upper wing is. So, if I have a 40-point upper wing, for example, I'm going to roll back at 920. If I have a 30-point upper wing, I'm going to roll back at 930. If I have a 20-point upper wing, I'm going to roll back at 940. So you can see how our rollback points are shifting to deal with the fact we're taking on additional down risk by moving our upper long strikes. That's essentially how the trade works mechanically. The specific rules are within the program. But let's just go a few days here just to show you how this plays out. Right, we got a big down move here, but we're still within our parameters for not making a down adjustment. And I'm just going to go to next adjustment here. If we come into, let me take the trade off. If we come into this time frame, May 3rd, you can see that we're starting to go negative delta as of this day. So we're going to correct that. We're going to correct that by moving these down. Again, if our capital starts to get too high, we'll start moving these up. And then we'll adjust the front wing to compensate for that. That's not necessary here, but that's the general procedure that we're using. So that's this day. Let's go to our next adjustment, which is May 10th. We have the same situation, right? We're negative delta. So we come in, we move this option down. In this case, we also had to move the lower option up. You can see if I ignore this, that our 860s went to 870, and we had some 950s come down to 940. And that helps us keep control of our capital and our risk to the downside. And if we go to next trade, same thing, negative delta. I'm going to reduce our upper wing. And I'm just going to go really fast because we have a lot of stuff to cover today. But same thing here, negative delta, moving the upper wing. And then I think the next adjustment is going to be our maximum adjustment, which is the maximum we're allowed to adjust this is right here. We're negative delta again. And we run into positive delta. And now from here, we're either going to hit a rollback point to exit it. We're going to be completely almost valueless here in our long options, in which case you can exit it just to take the risk off the table, or you just let it expire. So from here, our next adjustment would have had to be an exit. And this would have been our exit here. And realistically, you can just let it expire, or you can exit it a little bit early if you want to get into this one. 30 days to expiration if you were on a 30-day expiration time frame, you didn't want to overlap them. Or you could just simply wait to enter the following trade. Now, since we're on variable time frame, we wait to enter the following. We waited till 29 days to expiration to actually enter this. That's basically what the trade is. So an example of a 30-day to expiration exit or entry is going to be, if we go to to July, and this is going to be our most recently closed trade. If we go to July 22nd, we are now 30 days to expiration. We're now in an environment with our current implied volatility environment, we have been for the last year or so, where we go 30 days to expiration, we can put a 60-40 broken wing butterfly on, and we can automatically be positive delta. So here we're at 1485. If you go 17 to 27 points under the money, that's going to be 25 points in this case, using 10-point strikes. We're going to be at 1460 for our short strikes. We have a 60-point lower wing, got a 40-point upper wing. We are positive delta. We're good to go. So this is it. And basically what's going to happen in this configuration, if we get below 1460, we are going to roll this back and restart. Otherwise, we're looking for negative delta, we'll adjust it up. So if we go to our next adjustment here, that we go from July 22nd to August 4th, we are turning negative delta, we're up $2,400. We're going to take 5 of these, bring them to 1490. We're now positive delta again. Our capital levels are good. Go to a next adjustment here, which is the very next day. We hit negative delta again. We're going to make another jump adjustment. This time we are going to bring in our lower long strikes. And when to do that is actually defined within the program. But we're going to bring that up here. And now we're basically a little positive delta. Next adjustment is going to be here. We're negative delta again. So again, we do basically the same thing, right? So it's very, very simple strategy here. And next adjustment is here. Again, we did the same, same concept, right? We rolled in some lower longs, we rolled this in, this is what we look here, and then we'll just go to the exit, which if I show what this was, is going to be here, where we exit about $34.50 or so on our $35,000 plain capital, so just under 10% here. So that is the way this works. Now, how does this perform during the down days? Well, it's going to lose, right? So if we get really, really big down cycles, then that is when we're going to take our losses, because the bullishly biased strategy. So let's take a look at that, and I'm going to pull up returns for the year. For those people who haven't seen this yet, we track the strategies, or a lot of our major strategies we track on our Options Trading for Income Monday morning webinars, and we track the results from month to month. So these are real-time simulated trades, so they're not like backtesting. Where backtesting, you can go in and you can test, and if you didn't like your outcome, you can go back and you can change something. These here, we make our decisions are there. If I change them, we're going to get beat up, right? So we do this real time. So anyway, our profit and loss on January was 6%, and these are expirations. Expiration month. So January expiration months with 6%. February was minus 2.3. March was the big down time. That was minus 12 on that, so that slightly exceeded we like to be out at minus 7%, but we had a big gap, so that ended up minus 12. Then April was positive 17, May positive 15. We're solidly positive for the year by then, right, in 2 trades, which is the other good thing. The trading strategy makes enough money where you can pull out of a drawdown very, very quickly. Our June was 10.7, our July was 22.5, our August was just under 10%. So when it was rounded, it was 10%. So that is what we have now. September's up money. But so far for the year-to-date return, going through the down move, okay, and this is what I really want people to focus on, is yes, trading strategies will lose from time to time. You'll get those occasional losing cycles, but you have to take a look at the average long-term return of what things are doing. And I mean, take a look at this. We're in a slightly bullish strategy. We've been through the biggest crash that we've had in history as far as a point value goes, and we're up 67% for the year. I think our best year in this strategy was slightly over 80% return, and we're up 67%. There's a decent chance that we're going to break that record this year. So fantastic returns on the strategy for the year. So that's what we have there. But the power in this too isn't so much, it is a fantastic rules-based strategy that we can trade by the guidelines, but the real power in this is when we start to get subjective, when we start to get technical. So there's many, many different ways once we get subjective, and it depends on what your experience level is with this type of trading and so forth, but a very, very simple thing you can do is just simply play support bounces, play double bottoms, right? So like a support bounce like here, excellent entry, a double bottom, excellent entry. You get a breakout from a nice cup and handle pattern, again, makes a nice entry, a retest of a support level, so those are really good entries. And again, this is another double bottom here. And then you can also, I mean, entry is only half of your subjectivity. The other half of it is when to get out. And of course, we can always get out, or if you're going to take any kind of subjective exits, anytime we hit a price pattern target, anytime we hit it like a double top or a resistance level after an up run, are good times to subjectively exit these things. And then of course, we can combine this strategy too with the M3, the bearish butterfly, and the rock strategies. Because remember, every strategy has its weakness, and a lot of people, they come into this business saying, I want to find one strategy and trade it all the time, regardless of what you can do. And you can do that, and you can make money over time with like an M3 or a V32 or a bearish butterfly or a rock, or some of the other strategies out there that are some of the better ones. You can do that with those, but all of those strategies, regardless of what you have, you're going to have these downtimes. You're going to have there are going to be times when the market pushes against the weakness of those strategies. And when that happens, it's important not to just bail on it, if that's the type of trader you're going to be. If you're going to be a rules-based guidelines trader and you're actually going to be non-subjective, then you're better off just to cycle through those periods. If you want to bring your consistency up, if you want to bring your returns up, then we start talking about this type of stuff and knowing where the weaknesses of your particular strategy is, and then we can either modify the strategy we have, or we can combine it with other strategies that might be more beneficial for a particular environment. So Stephen, did you want to talk about this a little bit?
Yeah, I've John, we've discussed this before, but I think where the real value in this program and really in all of John's programs is you've kind of got the rote, the strict guidelines version of each trade, right? Mm-hmm. And that's what John just walked through on this. But the real value to me is how John shows in the program how you can mix and match this with other trades depending on your market opinion.
Right, because just as a side note for what you're saying too, Stephen, is when you're looking at a trading strategy, really the least valuable part of that strategy a lot of times, or at least if you're looking at my programs, the least valuable part of that strategy is the actual trade rules.
Yeah, that's just the start, right? That's chapter 1.
Exactly. The value that you actually get in these, which is why I'm open. If anybody wants me to ask me about a specific rule, I'm more than happy to give it to you. I'm not
Yeah.
trying to hide it behind a curtain. It's just that it's too complex to explain in the environment or the time frame that we have here. But so the rule base itself is not the real value in the program. The real value in the program is when we start talking about how to apply subjectivity, how to combine it with other strategies, where the weaknesses and strengths of the strategies are. When we start talking about those topics and being a good trader, that's the real value in the program.
Yeah, and I mean, it could be as simple as, you know what, this is a bullish market. We V-bottomed. I mean, you could have put this trade on any day of the week for the last, what has it been, 6 months, and it would have been an easy winner. Now, the way that looks is you're just rolling down upper longs and then based on certain triggers, rolling up the lower longs to take capital out of it, and that's it. I mean, that's the easiest way you can make money. Now, where the trap comes is where people think, I found the Holy Grail, and we all hear this, but it bears repeating. And then you just trade this through a wall. You've got to make sure that you're still in the right environment, you're still in alignment with the right environment, and you're trading it in alignment with what's going on. And like I said, that's where that subjectivity comes, because there's sort of 3 levels of subjectivity. John, stop me if you still got some other stuff, but
No.
I was going to segue into the subjectivity part of it is, just using the charts, then combining your IV analysis. What's the skew going to do? Is it going to flatten? Is it going to steepen? Because that doesn't always just follow what the market's going to do. Right now, for instance, we have a rising market and rising vol. We've had a volatility going up. That's information. That's something you want to be aware of. But you can't just use the charts. You can use the charts and your IV analysis. Then you get that sort of that third dimension is where you combine it with John's other legacy trades, the M3, the bearish butterfly, the rock. And that can be anything from you start out as a V32, you have a market opinion change and you switch to an M3 because you see a market stall and you want to have a tent over the market. And I'm just kind of being simple here, but really that's what we want to do is keep it simple, right? We don't want to complicate it. Let's say you start out in a V32, the market outruns you, you think the market's overextended, maybe you drop out of the V32, you've built up some profits in it, trading it as per the rules, and you transition into a bearish butterfly.
Exactly. Yeah. So you made some slides here. I figured I'd throw one up.
Oh yeah. I'll speak to that one in a second. And I'm just going to get the third legacy one is the rock. Same thing. Your lead trade, so to speak, in traditional rock is an M3. We're waiting for the market to outrun the M3 and theoretically hit a stall period or go sideways, find some balance, right? Because we go from trend to consolidation to trend to consolidation, trend to consolidation. And the rock's trying to catch the consolidation. So you instead of doing an M3 as the lead up trade to the rock as per the program, you could be in an M32, a 32. You're more bullish, you're in a 32, it's outrun, and you're more than likely going to have some profits built up in that, but maybe you feel like there's risk in the downside, or maybe you feel like, you know what, I think we're going to stall in a nice little range. I'll drop out of the V32 and go rock. So you could do that. Then there's this sort of fourth dimension where John's got shown, and I know this it's probably a little bit noisy, but what you can do is what I call morphing or hybrids. And this shows where you're still in the V32, but you start to add on rock component. And for those of you not familiar with rock, it's basically you've got a butterfly 20 points behind the market, and as the market goes higher, you'll add a butterfly 40 points above. The market goes higher, you'll add a third butterfly 20 points above. So keeping it simple, you'd have your V32. You think we're going to stall, but maybe you're outside the tent or on the edge of the tent on the V32. It's not going to gain a whole lot of value there. I don't know if you have the other slide, John, that I shared. Yeah, that one. That's the one I want. Yeah. So this is, you got a market stall. The red line, the red expiration line or red T+0 line is going to be your existing V32. Now that's a good position. You're fine. You're still inside the tent, but you haven't used all your capital. But let's say you've really identified a stall. You're not ready to commit totally to a rock position because that introduces, along with the high theta, more gamma. So
Okay.
why don't you split the difference and just say, hey, I'm going to go V32 and rock. And in this position, what we're doing is we're just adding a butterfly 40 points above, as per rock rules, 40 points above the shorts of the V32. And now you've got this hybrid position.
Yeah, that's excellent too, because you take away a lot of the upside risk that's associated with a normal rock trade at that point.
Yeah, and if you'll focus on your eyes on the green configuration, you've got a lot more tent range. Now the T+0 lines to the upside look very similar, but the green position, the hybrid rock V32 position, is going to gain value a lot faster. Now
Yeah, especially if you get a volatility drop like you
yeah,
might usually expect with an uptrending move.
Yeah, and then you could say, well, yeah, but now I've exposed my downside. Game of trade-offs, right? Never going to be free lunch, never going to have perfect thing. So the trade-off there is, yeah, I've got a little more exposure down there, but I have a plan to deal with that. Maybe I drop off those butterflies to the top. Maybe I roll up the upper longs of the V32, roll them back
That's
up.
right, and go into a standard rock configuration, yeah.
And can go into standard rock. And then the other is, if you're really concerned about a down move, maybe you shouldn't be in this position, but let's just say you're in it and the next day you feel like, wow, I still like the stall theory, but you know, I want to guard against some of this downside exposure. Roll up some of your lower longs, take out risk capital. And now you may have the same capital, and then you could play around with the delta that may give you. But I've always liked this idea that John introduced in the APM squared program was a gradual transition. I used the word morphing, hybrid. They're all the same. He's gradually moving from one to the other, and it really gives you a lot of optionality. You know, options give you options, right? As funny as that sounds, it's so true. So instead of just flipping right from V32 to a bearish butterfly, for instance, or to an M3 or to a rock, go in between. That's kind of the best of both worlds in a lot of ways.
It is the best of both worlds because, you know, like you said, the shifts can be really drastic. If somebody says, oh, should I put on a bearish butterfly or a V32, there's a huge difference between those two strategies in the T+0 line and the way they're going to react and when they're going to win and when they're going to lose. So, so like you said, you can go halfway if you're not quite sure about that yet.
Now, the beauty of this, of the V32 and the rock, is their duration usually, their durations of the trades usually match, right? So the rock starts as a 30-day trade. The V32 can and typically does start at 30 days. It can be longer. But so, you know, when you've identified a stall and you want to utilize the rock, you really are going to get paid when your duration is shorter and DTE and time is coming out of it. So that's a really good sort of match.
Absolutely.
A timing match. If you want to go to that next slide, John, I just wanted to show you how this goes from straight V32, which we've identified with the arrows, which I guess you could call that the red or rust-colored expiration, is your V32.
Right.
And
the
then how
trade.
and then how we slowly morph it by adding butterflies above the market to what we can call a hybrid position, and then the full-on rock, which is the blue, and that's going to be rock half-entered. And for those who aren't familiar, it would be 10 butterflies below the market, which would be part of your V32, and then you'd have 5 butterflies above the market, so half the number of butterflies, so that's rock half entered. And then of course you could see how the T+0 lines change. They do give you more risk to the downside, they change your upside, but what this doesn't show is how much your theta is lifting.
Yeah, it's going to make a huge, huge theta difference.
Huge difference in the theta lift, and this is at 28 DTE, so, you know, a little bit early to be in full-blown rock, but the point
depends on the environment, but yeah.
Depends. I was going to say, the point here is it depends on your market opinion, your environment, but it shows you over time what this position would look like in a static view, how you're changing it from more of a bullish posture where you're more or less lifting up the expiration line to the right to a more
almost more bearish posture there.
More sort of bearish stall posture where you're getting more and more, where John's got his cursor and where the green line is, you see how you have increasingly more tent above you. just where the market is at 1508. Yeah.
Mm-hmm.
See, if you go from the V32 where the red expiration line is, and then as you go up and expand towards rock, if you'll go over where the market is, yeah, right there. See how you just have increasingly more and more tint above you, and as you stall, you're going to get paid for that.
Yeah, yeah, definitely. So you're not only playing your delta a little bit, but you're also playing your implied volatility.
Exactly. So that's kind of what I call fourth dimension, where you kind of go, and maybe that's the third dimension, and however you want to look at it, you can either go full blown switch out of V32 into the rock or an M3, as the case may be, or you could do this sort of hybrid thing. Now, I've teed up an example, John. I don't know if you want me to run through it.
Yeah,
Okay.
if it's relatively fast, then we'll
I think it's. I'll go through it faster. Okay.
So your option view. Okay, awesome.
Okay, so this is just early this year. Let me just set the stage. Low implied volatility environment, relatively small ATR, moving up, just grinding up, right? Just nauseatingly going up. So, you're like, oh, bullish environment, let's get into V32. So I just wanted to point out this little bit of a nuance. The trade as is positive delta, which is kind of how, we say if it's positive delta, we can get in.
Mm-hmm. Yep.
But let's say you're like, this thing's going to crash any day.
You're concerned, right?
Yeah, there's this virus out there. Then roll up your upper longs, and you can flatten this out. Now, depending on the time of day, so on and so forth, it's a little bit negative. Earlier I had it was positive, but whatever. I just wanted to point out that you could toggle your delta real easy by moving your upper longs around. And it does give you some downside change, not necessarily, a little bit to the upside as well, but that's how you would do that. You could still, this shows negative, earlier was positive, but I was going to say you could still have a little bit of positive delta even if you make that change. So this is where we're at. Let's say we're just, we're pretty bullish. As you can see, the upside risk is minimal. We don't have our 35,000 in the trade yet, or, we still got a little capacity there, plenty of room. We're off and running. Let's just check prices. Bottomed out in 18, run into the sky. Feels a lot like what we're doing now. Okay, great. Let's go to the next adjustment. Okay. Here you could see without the adjustment, this is the trade. We're just still in the V32. It's doing its thing, right? And without the adjustment, you really wouldn't, you would trigger, let's see if I did do anything. Yeah. This is a little bit different sometimes when you do back test. This on the borderline, let's call that just even. You may or may not adjust. You could keep it. But let's just say we've really run for a while. We're running into the bottoms of these support levels. I think we might stall. Might pull back and stall. Hey, why don't we do hybrid rock? So what we did, so our shorts down here in the V32 are 1430, so let's add 5, which would be half the number of butterflies in the put side. So we've got 5 call butterflies, and we're adding
the 50 points over, looks like, yeah.
Those are 50 points over. Well, it should be 40, but let's go with it.
But that's okay.
That's okay. Let's go with it.
Yeah.
You would normally say 40, and just for argument's sake, let's see what it looked like, because this does work out just fine, which kind of proves the point, right? Sometimes we make mistakes in real life too. Not that this
yes, we do.
That would be with 40 points.
Right, right.
50 points. See what 50 points does? Not really a difference to T plus 0 line within a decent range. Really, the position's not all that different.
No, it's going to be very similar, right? And people get so hung up. Is it 35 points or 42 points or 42 and a half points? And the reality is you can have a lot of variation there, and still, as long as you're under concept, you're fine.
Right. That's a great point. And John always tries to drive that home is, stay in concept, right? Maybe it is 50 points. Maybe it's 40. Maybe you're protecting against this giant up move, but you think there's a stall. Really, the positions, if you're looking at it from a T plus 0 line standpoint, are pretty similar. Even over time, they're not changing much. So it doesn't matter. Yeah. Right? So
it doesn't matter unless you knew exactly what was going to happen in the market.
Yeah. And if we knew that, we'd be playing the lottery and playing on an island that John bought, right?
Yeah, that's right.
So let's go to the next adjustment. So it'll look like the market's kind of heading up on us here. Let's see what we did. Yeah, so we got 45 negative delta before any adjustment. And right now you just keep it simple and you say, well, if I were just in the V32, that's negative, I would roll down upper longs to try to get more close to positive. Now in this case, I don't want to go positive delta because I got a butterfly up front. I got a butterfly up top. That would be, I'd like to maintain a little bit of negative, but see how nice and flat it is? I've got a lot of headroom with some tent. If we just puke it up to the downside, I've got nice tent. I mean, this is just really attractive, but I just wanted to make the point, once you've morphed into a rock, now remember a rock, your rock half inner position target delta is minus 180 and our V32 is positive. So, you know, you're just making the argument that I want to be something between there, you know, you could be reasonable. I probably don't want to be 100 delta. You just, you know, you want to look at your T+0 line and what's the risk to the upside with a 30, 40 point move? Do I have room and to the downside? So this is where the subjectivity comes in, but you still have guidelines and goalposts, right? So we know 180 is way too high. 100 is probably too high. I don't want to probably be positive delta. So something around there in between is kind of a Goldilocks position.
That's a good point, because I was actually on a one-on-one coaching session because we talked about the APM squared program where we do a lot of gradual rock transitions from like M3s and stuff. And that was the thing. Well, I don't know the exact delta that I need when I do that. And I said, well, as you become more and more skilled and advanced as a trader, you're not really so much concerned about the exact numbers anymore. You have your goalposts that you, like you said, that you may not want to do, but what you know is you're gradually transitioning from a trade that allows maybe minus 15 delta, or in this case, positive delta, to a trade that allows 180 delta. So that being the case, you do the gradual transition, right?
Right, and yeah, and what's, you know, what I've always used is to say, you know, with a certain move, 30, 40 points, you know, I base it off ATR. So if ATR is 20, then you probably want to use, let's do 1.5 times that. So I would go up 30 points and see what the position P&L would be. If I'm okay with that, you know, if it's not max loss, then that position's fine. And go down 30 points. Is the position within reason there? Is it, you know, above max loss? So that is really going to tell you more in some instances than just raw delta.
Exactly.
Can the position handle some range? That's the question you want to constantly ask yourself.
Right, given the environment that you're in.
Given the environment, and let's just check on, you know, we have about 36,000 in there, so that's roughly 35. I'm not too panicked about it. Our thesis is still kind of holding true, although we've tested, backed off, and kind of heading up, so we could be breaking out to the upside, but let's just say we're staying with our thesis of stall, but we've got some good range. And notice how the trade's gaining some value. We've only been in it a week. Now this particular day, the market is still zooming higher. So in this one, we gained a lot of value for one, even on an up day, and negative 53 delta. This is position before adjustments. You know, you could make the argument this is fine. It all depends on your opinion, but you could see as we move up, you're going to start giving back money. A 30-point move. 15. You know, to me, that's giving back all my profits, so I don't like that. See how I just did that? I didn't just say, oh, it's 53 delta, it's too high. It's what does 30-point move to the upside do to the position? Gets back all my profits. I don't like that. I'm going to adjust. So what I'm going to do is I'm going to roll down upper longs, just using the 32. And
I might be perfectly fine with that.
And you might be perfectly fine with it. There's no right answer, right?
Right, and we can both be right,
and we could both be right. Yeah,
we could both be
wrong.
Right,
and you know what? And be happy with it because we're following a process.
Right.
So I'm going to take the easiest way to take out some of this negative delta is to stick with the V32 concept. Now I could roll this butterfly up here down. It's upper long, but since we're in that butterfly, I'd kind of like to keep that one as is and keeps me more flexible. You could make the argument either way, but what I did was try to stick a little bit more with what the V32 does is I rolled down the upper longs, and to take out some capital, because that puts us over the capital, I'm going to roll up some of the lower longs. Probably could have been more aggressive with it, but I rolled up half.
Sure.
back to our 35. Now see how this is sort of back to the position we had yesterday? It's a little flatter. I don't give back as much money to the upside. I could still be up $1,000. And it's just such a sweet spot because of the range, the range. And the delta is 33. You're like, oh, you're in a V32. It needs to be positive delta. No, I'm in a hybrid position. I want a little negative delta. I've got tons more theta than I would had I had on, if I had on just a V32. Let's just take this out, show you what it looks like. I wouldn't have 133 theta
versus 361.
I got twice as much with the hybrid position.
Yeah.
And see how it's just running away from you? You're only going to make, I shouldn't say that. You will make whatever this expiration line gets up to, which is fine. You don't have as much risk, so it's a game of trade-offs, right?
Mm-hmm.
So there's the superimposed of the two trades. If we were just in the V32, it'd be the green expiration line. Basically no risk to the upside. If you're in this,
some people want to go for a little more, that's all, right?
Yeah, that's exactly what it is, John. Yeah, and I had a thesis. I had a stall thesis, right? It may or may not be playing out. Had we stalled, I'd be way up in here and make a lot more. But I'm no worse off so far.
So
I'd rather be in a position I'm no worse off, but with also the opportunity to make more. We're up to $3,000, which is already a nice little gain in this trade. Some people might say I'm gone. Now what I did here, oh, I'm sorry, I spoke too soon. 4,300.
Right.
Been in the trade two weeks. That's probably a good time to take off. Let me show you the position before an adjustment. This is where it really gets subjective, right? You could say, okay, the market, my thesis is probably not holding. It's running, getting a little steep up here. We're at 14 days, so gamma's now kind of a concern. There's all sorts of things you could do here, but I like the profit that I've made. And let me just continue the example. If we go up 30 points from here, that's about 15, 25. I'm almost giving them all back my money back. And I'm kind of not running out of time, but it's getting to that sort of witching hour, if you will, that 14 to 10 DTE period where you kind of want to start being careful. And I just said, you know what, let's stay in the trade, but preserve profits. So I drop out of the V32. And now I'm just I rolled in the upper longs on the call butterfly.
Now you're almost in an upper V32.
Right. I'm with almost no
more an M3.4U at this point. Yeah.
Exactly. And see, I've only got $8,000 in the trade. So it'd be really hard to ever hit max loss.
Yeah, almost impossible.
And that's where you want to be. I still got an opportunity to make some profits if we stall up in here. If we start running up, I can start lifting this T+0 line, which is what the trade ends up doing. And it, depending from here on out, there's any number of things you could do. The trade ends up around, if you run it all the way to expiration, about this, makes about 4,000. So it keeps you in the game with still the ability to try to make more. Had the market stayed where it is now, give or take, it could have made the 6,000, 7,000, whatever. But at least you're giving it a chance with very little risk. You don't have that much capital in the trade, so.
Right, exactly.
So that's basically what I wanted to show, John.
Yeah, no, that's fantastic. So that's a good example of combining this with a rock trade. And again, you can do it with M3. We know when we get into an M3, we start to pull into expiration. If we get into a constantly up-grinding market, the thing's just not going to make any money. If you find yourself in that situation, you can just flip it over.
Yeah, and it wasn't that complicated, right? You just...
No, it's selling a call and moving some long strikes, basically.
Yeah.
Yeah.
So we do have a question from Tyler here. It says, if we want to combine the V32 with other trades mentioned, would we need to be using option view compared to one?
So I can address that if you'd like. So if you're just combining with M3, we do have new ONE guidelines out for the M3. If you have the M3 program, we have a section in there on what the modifications are, and then you would use ONE with that. If you do not, then I would suggest using option view. If you're combining with the M3, same thing if you're doing rock and Bearish Butterfly, I would tend to use the option view software because we don't have the new guidelines out yet for the rock and the Bearish Butterfly in ONE. The truth is, once you actually become advanced or skilled at this level of trading, you're not going to be so dependent on Delta where it's going to matter what software you use. In other words, as a beginner trader or as a straight rules guidelines trader, that makes you very, very dependent on the analytical software you're using, because that's the way you back tested it, and therefore that's the way you want to trade it forward. When you start to get subjective, you're not really using an exact delta. You're using, as Stephen was showing, more of a range or a feeling, and at that point you're going to be subjective at where you're going to adjust it anyway, so it's not really going to matter what analytical software you have. So that's the way I would put it. You agree with that, Stephen? No.
Yeah, I mean, that makes sense. I don't think it's totally required to have option view to do these trades, so it's definitely can be done in the other ones. And especially when you start, you want to start out where you're trading by the rules anyway, so you get a feel for the trade.
That's how we start, right?
I mean, we're not going to just get the program and boom, start trading subjective. We want to get the basics down, and you're going to be doing that in ONE, and you'll start to get a sense. Backtest 2013, backtest 2018, see how the two trades performed and different and why.
Mm-hmm.
At entry, how they set up and how they perform when those transitions occur. Then exactly. You can start to factor in your subjectivity. For me, this trade is very much about, from a subjective or discretionary standpoint, is trade entry.
Mm-hmm.
Looking at the charts and saying, we've hit support. That's always the easiest one, right?
We just say, I don't think we're going to go down that much. I mean,
or we're not going to go down that much, and I'm getting in. Where you get in trouble, and this is kind of human nature with anything, is we always buy a stock after it's already gone to the moon, right? Like, yeah, should we buy Apple now that it's $2 trillion and $525? Probably not.
Mm-hmm.
Be a little sarcastic. And that's the same with the V32. Don't wait until we've broken out and we've run 80 points and put the V32 on.
If you're being subjective, right?
I'm saying absolutely. When you are adding, that's kind of level one subjectivity, and this, you'll find that this trade really does great when you can get in at the beginnings of an up move rather than at the end. And I know that sounds so simple, but hey, anybody that's traded for any amount of time, you tell me where the beginning and the end of the move is, and again, we'll be buying islands. I mean,
well, it takes some experience, and you
know what's going to happen tomorrow, right?
You're not going to be right all the time, but there are certainly times, I think we can all agree, where the market's not likely to go down anymore.
Right.
And taking advantage of those times in a trade like this is absolutely fantastic.
Yeah. Here, I'll stop share and
let me share my screen if I can. All right, so that is a great overview of the V32 trading strategy. So we use these strategies to maximize our returns in uptrending markets, to gain profits more quickly in stagnant markets through faster theta decay, because we're closer to expiration than we are with a lot of income type strategies. I like the fact that we can trade it in a small size, so we can build our confidence while trading maybe $35,000 or $7,000, rather than trying to trade this very large position where you have psychological issues going on because of potential losses. So you can build your confidence with those small trade sizes. You can be certain of your next move if you're using the strict rule-based guidelines. The strict rule-based guidelines are pretty specific, so you can be certain of what your next move is going to be. You can simplify your trading through fewer adjustments and without overlapping trades. One of the biggest challenges, especially if you're a newer trader, if you get into overlapping trades, you're dealing with two trades at the same time. It can be confusing for some people. And one of the things I really love about this is that we can take advantage of those nasty down-up whipsaws. And we can do that in two contexts, right? We can do it in the context of, hey, I'm trading a V32, the market went down, I had to roll back, and then all of a sudden it rips to the upside like crazy, and you can still make money like 99% of the time when that happens with this trade. Or you might be in something else. You might be in a bearish butterfly or a rhino trade, for example, or something like that, where when you get whipsawed like that, you're generally going to lose. And you can convert over to a V32. So you can take advantage of those situations. And our more advanced traders utilize the V32 strategy subjectively for increased consistency and much better returns. So I encourage you to take back your power. Hope you enjoyed the presentation, and I hope you join us with the V32 in the winner's circle. Thank you, and trade well, everyone.